Joining us now is David Zervos of Jefferies and Warren Pies of 3Fourteen Research. David, the real estate sector led the S&P today, up more than 2%. KRE Regional Bank Index was up 5%. How does this feeling that we may have reached peak rates influence those and then these other equity moves that we're seeing?
You know, I think a lot of that, Jonathan, it's all the rate move, right? It's the real estate investment trusts have all been hit because of the refinancing risk on commercial real estate. And KRE is all of the underwater holdings that they haven't marked to market. And that's why it was down 20%. And now it's only down 15 or 14%. I didn't look at the final for today, but it's still down a lot for the year with the big banks up much more. I think JP Morgan was up, 30 or 30% or something like that, 25. So, I mean, there's still a lot of dispersion, but this is all rates. Everything that's going on here is the move from 5% 10 years down to 4.25% 10 years. We're repricing the dollar. We're repricing higher for longer. People are getting a little bit ahead of their skis, I think. I don't think it's going to come as soon as people think, but the inflation data is great, and I think the Fed looks about as good as they could look, given the scenario that's developed in the last 18 months since we peaked at 9% inflation.
Warren, we've got Fed Chair Powell trying to talk down expectations of a rate cut today. Have a listen.
It would be premature to conclude with confidence that we have achieved a sufficiently restrictive stance or to speculate on when policy might ease. We are prepared to tighten policy further if it becomes appropriate to do so.
Market doesn't seem to believe that Dad is really coming downstairs to enforce that necessarily. So what do you think the impact is from here? Can the Fed talk the market down? Is that necessarily what's happening here? And how important then is this next Fed meeting?
Well, I think the next Fed meeting is their last chance, really, before the next year and the potential cut cycle starts. That's where they release their summary of economic projections. And, you know, I think there's some things they could do at the terminal rate and try and pressure the market in certain ways and send a signal. But I think at this point, kind of the horse has left the barn. And you have to look back to really, I think, a battle that's taken place within the Fed between John Williams of the New York Fed and Chris Waller at Minneapolis Fed. And Williams is kind of a dove, and he's kind of argued for months that what's going to happen is we're going to pause and then inflation is going to fall and we're going to have to cut rates to maintain restrictive policy. And so he's saying cutting is part of this restrictive phase, which is kind of this way of backdooring an attempt at a soft landing. And Waller confirmed that this week. And so he came out as this quintessential hawk, and now he came out and has blessed that kind of approach and says that he's seen something change. The unemployment rate has gone up, and we're seeing loosening in the labor market. And when we look at the inflation data, it's on a glide path lower just because of shelter inflation at the very least. It's 42% a core, and we can kind of back out that that's going to be a rapid level of disinflation. So from our perspective, there were always three big elements to a soft landing. You needed, obviously, a resilient economy. You needed rapid disinflation, and then a hyper-reactive Fed. We were doubtful the Fed would be hyper-reactive, but the comments from Waller this week, I think that's what's really driving what you've seen in the futures market expectations for cuts. And in my opinion, our opinion, from the way we look at the data now, I can't make a recessionary case. This fall in rates is very stimulative to a real estate market that's been resilient as can be, and ultimately, you know, that's what I see happening is the economy staying strong and cuts in May.